Hey there, everyone. Apologies for the late kickoff, but thanks so much for joining me here on Chart This with Dave Keller. It's Tuesday, March 11th, and I'm your host, Dave Keller, coming to you from a beautifully cool and overcast Redmond, Washington. Great to be with you here today as the great bear market of 2025 persists. And I say that with a dose of insincerity and sarcasm, but still TBD in terms of how much of a decline we're going to eventually see before a major low. It felt like we might be getting the bottom earlier today. We're around the 3 p.m. hour. We're actually slightly higher, but defeat snatched from the jaws of victory as the S&P closes slightly lower, about 0.75% to the downside. So today we're going to talk about today's negative follow-through day after the big down day yesterday, one of the biggest losses for the NASDAQ in about 4 or 5 years. We'll talk about what happened today. Really kind of a digestion day more than anything, to be honest with you. Think of yesterday as the big meal or the big puking out, I guess, is probably a better analogy. And then today's sort of the digestion day, right? The after party as we sort of lick our wounds and see what happens next. Technology ended up being the best performer, but all 11 of the S&P sectors were down. Let's get right to the market recap and see how things actually played out. All right, here we go. You can see the S&P finishing 55.72 at the close. That's down about 0.75% from Monday's close. And again, Monday, the big distribution day today. Again, by about 3 p.m., we're about even with yesterday's close, but the sell-off in the last hour, implying some institutional selling going into the close, brings the S&P 500 down to around 55.70. The Dow led lower for most of the day, ended up down about 1.1%. The NASDAQ Composite down 0.2%. Mid caps and small caps both down a little less than the S&P 500, about 0.5% each. You can see the VIX actually moved slightly lower. And as a friendly reminder, just because the S&P is down does not mean the VIX is up, right? We have a natural inverse relationship between stock movements and volatility. However, it is not a perfect inverse correlation, meaning day to day, you could see the S&P down and the VIX down, which is exactly what we saw today. VIX about a full point lower, and the end of the day around 27. Now, I'm not showing the VIX of the VIX, but you can actually chart the VIX of the VIX, right? The volatility of the volatility. That's going to be elevated, and that's where we're seeing quite a bit of movement with significant swings in the VIX day in, day out. Looking at bond markets, and a shout out to my friends at Forex Analytics. I caught up with Dale Pinkert and the team at Forex Analytics in their FACE interview, which is a pre-market interview that I like to do about once a quarter. I had a really fun conversation with Dale, as always, talking about some of the technical implications. That group, I mean, they often have a little more of a short-term focus, certainly more of a foreign exchange commodity focus than I do, where I'm focused more on equities and ETFs. But it's really interesting to sort of compare notes with someone like Dale and think about the relationship between what I'm seeing with stocks and what I'm seeing in my own work, looking at the commodity markets, currency markets, and so forth. Let's see. The dollar slightly lower today, about 0.6% to the downside. That's something to watch, right? I mean, I think the continued downtrend in the dollar has certainly been weighing on U.S. markets relative to non-U.S. markets, right? If you look at the ratio of the SPY to ACWI, which is an ETF that tracks a popular index in the institutional community called the All Country World Index, which comes from MSCI. It's a Morgan Stanley group. It was favoring the U.S. over non-U.S. for most of 2024, if not all of it. In 2025, we've had a weaker dollar, and we've not surprisingly seen U.S. markets underperform non-U.S. markets, from developed Europe to China to a lot of markets as well. It feels like the U.S. dominance from a technical perspective certainly changing, and I think the weaker dollar environment, changing the interest rate environment, all sort of part of that evolving theme that I don't see as necessarily done just yet. Speaking of bonds, the TLT down another 0.7% today. That's an ETF that tracks bond prices, gently sort of stepwise motion lower through the course of the day. Interest rates generally moved higher today. The 10-year yield finished today just below 4.3%. The long bond yield is back up to 4.6%, and the 5-year yield back above 4%. Looking at the commodity space, we can see the DBC, which is a broad commodity ETF, finished slightly higher, about 0.6% to the upside. Gold and silver kind of resuming their uptrend ways. The GLD was up about 1.2%. Silver up almost 3%, copper up there as well. So precious metals remaining a very strong area of the market, particularly relative to large cap US stocks. I mean, it's been not even close, that comparison between those two particular areas of the market. Finally, looking at the cryptocurrency space, nice to see a bit of an update after yesterday's carnage. Bitcoin and other cryptocurrencies sold off pretty aggressively yesterday, along with the equity markets. Bitcoin actually ended up finding a low right below 77,000 earlier in the 24-hour session that is almost done. Currently, we're trading just above 83,000. So for now, up about 6% from the end of the previous 24-hour period. All right, looking at the 11 S&P sectors, what do we have? You know, technology going into the last hour was the only one of the 11 S&P sectors still in the green. Did not hold up through the end of the day, but still the top performing sector. And I think that's interesting because technology has been an absolute dog here in the last month, right? Month of March in particular, we've seen technology really accelerate to the downside. What you're going to see as we look through some of the charts, I would argue charts like NVIDIA are still in a downtrend, right? And a lot of the semiconductor names, a lot of technology names I would float your way are not particularly strong charts, but they're bouncing today, right? And the potential bounce after that significant sell-off yesterday where the Nasdaq's down 4%. Again, I would be amazed if technology and if something like the Nasdaq didn't have at least some sort of bounce after that sort of significant move. One of the realities, and I'm foreshadowing a little bit what we'll see on some of the charts. What you have to remember is if you look back at market history, some of the biggest one-day moves, the biggest up days, happen in bearish trends, right? We think of big up days happening in bull markets. They don't. They actually happen way more in bear phases, in corrective phases, because you have these big sell-offs, and then you have these snapback rallies that accelerate quickly to the upside. Those bear market rallies, I always say they are sudden, swift, and seductive. That's the way I like to describe them. They are very, very sudden. They happen out of nowhere. They are swift. They are very rapid in terms of how quickly they accelerate. And they're seductive because one of the things they do is draw a lot of people in thinking, all right, that's the bottom. There's a FOMO that happens in this kind of environment where we don't want to miss the next leg higher. We don't want to miss this being a really buyable dip before the S&P goes back to 6,100. So that initial move higher, all of a sudden a bunch of people buy into it. But then once that doesn't work, that's when the next leg of the bear market can be equally as uncomfortable. After technology, you have materials, you have energy, number 2 and number 3, both down about 0.8% today. Financials, number 4. And that's an interesting one because honestly, in the financial sector, you have a very big differentiation, I would say right now, between some of the big banks that are not particularly strong. I mean, they're all showing divergences. They're all kind of breaking down like JP Morgan, Bank of America types of names. But compare those to exchanges, right? Like SIBO, like ICE, Market Access, we mentioned, right? Names that are starting to, some of them have been trending higher for quite some time in these nice, strong uptrend phases. On the downside, industrials, the worst sector today, down 1.5%, about the same for communication services and consumer staples, all down about 1.5% today. So, you know, again, while the major averages were kind of barely almost in the green going into the close, a lot of sectors ended up having a pretty decent down day. Looking at the breadth very, very quickly, we can see that the breadth was way more on the downside than the upside, particularly in the S&P 500. This is one of those days where there's quite a difference between the S&P and the NASDAQ. On the S&P, about a 3-to-1 ratio of decliners versus advancers. It was more of a coin flip and slightly more advancers than decliners for the NASDAQ composite. So there's the difference today with the S&P 500, a lot more stocks going down. Obviously, that's a more value, still very a growth-oriented index, but a much bigger representation in the value sectors, many of which, as we just highlighted, struggling a bit here. Our market trend model as of last Friday, bearish on the medium-term time frame. For me, going into this week, certainly felt like a big issue and an exclamation point on the correction that we've been talking about as a likely pattern. Yesterday, of course, sort of confirming that I would argue bearish thesis is well defined here. Tesla, it turns out, can actually go higher. You can see Tesla up about 3.8% today after President Trump and others claim they will be buying a new Tesla. I'd love to see that happen. But Tesla having a nice counter trend bounce. To be clear, these are really rough charts that have been going down for quite some time. So a 3.8% gain doesn't begin to erase any of the major declines that we've seen, as the stock has gone from 425 to 225 in the last about 2 months of trading. So you have to have a lot more of a recovery to make that chart look anything but horrible at the particular moment. Netflix also having a pretty good update, though, up about 3.8%. And what you're going to find on some of these charts, and I didn't grab many of these. I might have grabbed one of these FANG stocks, I want to say, for the chart review portion of the day. But what we're seeing with charts like Netflix is pretty common. These are stocks that have been going down quite a bit. Obviously, large cap growth has been a weaker area of the market here over the last 2 weeks. You're seeing bounces off of fairly low levels. You're seeing some of those names like consumer staples, which had rallied up to their 200-day, pulling back. So today was a bit of a mean reversion move, or as we described it, a digestion move after what we've seen recently. One Magnificent Seven stock that did not get a counter trend bounce today, Apple. Apple continuing to go from bad to worse after touching 250, now down briefly below 220 today, which undercuts the late January low. I would say this is a very vulnerable chart among vulnerable charts, but certainly the sell-off so far this week suggests we're at least in a brief period of distribution. All right, let us go to the market carpet. As a reminder, I can see any questions you're popping in on our live stream on Facebook, LinkedIn, YouTube, and X. I appreciate you so much tuning in. By the way, the reason why we started a couple minutes late, I had a helper come in, an AV consultant, to critically look at the AV that I'd set up in my own home office. I'm still using some COVID era technology. This is, COVID, all of a sudden we're working from home, and I set up a home office so I could record content. I'm still using some of those same setups. And so I asked someone to come out and look at what I was doing, give me some feedback and some ways to improve it. So we actually moved some things around that you can't see, but I hope the show looks and sounds better and better as we continue on. Hopefully the beginning of much more great things to come for Chart This and Market Misbehavior. Here's hoping. But by the way, I can't see the questions you're putting in on any of those destinations that I mentioned. Thanks so much for making the show interactive. Thanks so much for sharing thoughts along the way as we recap the markets, look at the heat map, look at the charts, and then at the end of the episode, I'll take a question or two before we wrap for the day. All right, looking at the heat map, I mean, I'm telling you what a mixed experience. I always say a modeled experience on this sort of day. I mean, I'm definitely seeing plenty of red, right? And so while it felt at one point like this was going to be a counter trend bounce and this could be a decent recovery day, that's not what I'm seeing when I'm looking at the heat map here. I would say some areas of the market obviously quite strong. Some areas of the market actually struggling quite a bit just today, and even sector to sector, right? If you look at technology in the upper left, you look at consumer discretionary, look at communication services, you'll see some stocks that were up 3+%. You'll see some stocks that were down 3+%, and a bunch of things in the middle. So this very much feels like a digestion day. And again, we had a big move. It's pretty normal to have a kind of choppy consolidation day as investors are not 100% sure what's next. It was obviously a big drop yesterday that I think surprised a lot of people in an uncomfortable way. So today's kind of a backing and filling, kind of see what happens type of day. So on this kind of day where the benchmarks were essentially flat, particularly look for things that were showing excessive strength and look for things that were showing excessive weakness. The bright green and the bright red, I think, are important to sort of see where you might have some opportunities. Within technology, I mean, again, I'd love to tell you something like Palantir, great that it's up 2%. I still see that as a primary downtrend after going from 125 to now the upper 70s. Just in the last couple of weeks, it certainly could recover and have a new leg higher, but that leg is not starting today by my read. Same with like ServiceNow. A lot of these stocks that are in the green and are up the most today in technology in particular are the charts that have been beaten down the most on the way down, right? These are the ones that have been struggling. So again, it very much feels like a dead cat bounce, which is where, you have a big protracted sell-off. You have a quick, sudden reaction bounce. And it feels tempting to see the stock up a bit after being down so much, but usually is just like a pause before kind of the next leg lower. I'm not seeing enough on those general charts to be really encouraged about what I'm seeing there. Within consumer discretionary, I mean, Amazon comes to mind because all of these stocks that are failing to hold their 200-day moving average not only mean not great things for those particular stocks, but they also mean not great things for the market as a whole, right? And that's where the breadth indicator of looking at the percent of stocks above their 200-day moving average. That's why that's a thing that we do, because in a healthy market, in a bull market environment, you'll have stocks that pull back, right? Pullbacks happen in the healthiest of bull markets. You'll have 3 to 5% pullbacks all the time, right? Often during a normal bullish year, but they hold, right? They hold the 50-day ideally. If not, they hold the 200-day. And what's happening now is these stocks are selling off to the point where they're breaking that key level of support. And for me, that's a bit of a concern. Energy is an interesting one. And I talked with, I mentioned Dale Pinkert at Forex Analytics earlier today about the energy space, talked about crude oil prices. He was talking about a bounce in crude oil and how to potentially play that. I could see that as a counter trend move for sure. I would say, and if it does, I mean, I would say energy stocks could be an interesting way to play that. However, from a purely technical perspective, I'm looking at the configuration of a ConocoPhillips. Again, while it's bounced a little bit, I still don't see that as a great chart, right? I mean, it's not even a good chart at this point. And this is where I think you need to differentiate. If you're a swing trader, I don't mind you trying to play a move like this and playing a counter trend rally to a declining 50-day moving average, optimistically taking a counter trend rally to a 200-day moving average. I get it, and I get the argument. And I could see that as being an approach. For me as a trend follower, I'm immediately seeing a stock below two downward sloping moving averages. I'm seeing counter trend rallies that are making lower highs. So while the short term, the tactical trend can be encouraging, there's a bounce that maybe you can play. I don't see that as something I would want to as an investment, right? It's like a trade, not an investment, if that makes sense. And one of the tricks for things like ConocoPhillips, in my opinion, to remind you of the overall trend. And Stock Charts has a really good feature where you go here to opacity and make it 0. What that basically means is get rid of the price and show me just the moving averages and look at chart and recognize the shape of the moving averages and the slope of the moving average is a really interesting data point in my experience. So stocks where the 50-day is below the 200-day and they're both sloping downwards, as encouraging as it might be over the last couple of days, it's still in a downtrend. It's in a primary downtrend based on that basic assessment. At least the 50-day turning higher tells you maybe there's something to get excited about. The 200-day sloping higher is the real measure. So if you look at this trend with the 200-day sloping higher kind of into May, June, and then sloping downwards pretty much steadily since then, if we bring that back up to normal, and kind of go back, that's why you're kind of capturing this as the bullish phase and then this as the bearish phase. And that feels about right. And so that tells me that, again, just looking at the slope of the 200-day moving average, those are the things that I would encourage you to reflect on if you get really tempted to be buying a name like COP, not as a trade, but like as a bigger investment. I just don't see enough from a technical perspective to suggest that this is in an accumulation phase. A higher low, changes to the moving averages, improving momentum. Those are things that I think could be a positive sign, but I'm not seeing it yet. All right, looking at the heat map. Anything else that I would want to highlight? I mean, I guess the other thing is obviously a bit of a change here with the defensive sectors like consumer staples not doing particularly well. With a lot of these names have actually been in a pretty good rally mode. They've been bouncing quite a bit. And something like Colgate-Palmolive is a good example of what stocks in this sector have been doing. Kind of a nice rally. Now, a lot of these are either at their 200-day, have recently pushed above their 200-day. Colgate-Palmolive was notable yesterday for a shooting star candle, which is when the open and close are near one another after an uptrend. You have a long upper shadow, limited lower shadow. That tells you the next 1 to 3 bars are most likely down. So some of these names that had really good rallies ended up having those distribution candles in defensive sectors. They're all down today, a lot of them. And so again, this feels like sort of a mean reversion to the trend that has been the primary trend since mid-February now to mid-March. So again, I don't see anything on the charts today telling me, this is a big a big change of sorts. I see this as a continuation, maybe a brief counter trend move relative to the trend that we've been observing. All right, let's go to the chart review portion. We'll look at the charts here one by one. Again, keep the questions coming. We'll take a question or two before we wrap, and we'll call it an evening. I just want to keep this on here today. This is the 10%, really 9.7% drop that we've had from mid-February, really to the 55.50 level, right around the middle of today's range. That percentage is there because that's how deep the correction in July to August was, right? That pullback phase from mid-July to early August was 9.7%. So I'm keeping that on there just to put a historical frame of reference. So, you know, a number of people that I've heard or spoken to have said, well, it's, you know, this is about as deep of a pullback as we would get in a normal, you know, in sort of the bullish trend that we've been in. Is probably where we get a tradable low. You know, it depends on what you mean by tradable low. In this kind of move, would I expect a bounce up to the 200-day moving average? Yes. I think that would be a very reasonable and actually well-documented technical phenomenon when you've had a market that's sold off to the degree that it has. Things you look for in this environment are we start to break down to the point that the stock market or the S&P becomes oversold. We're oversold today. We were oversold as of yesterday's close. The last time we were oversold was at the August low. The time before that, we were not quite to the oversold level, but really close, was at the April low. So pretty common that you would have, a bounce out of oversold conditions. But the problem is what happens next, right? Do I see a return to 6,100 or 6,150 as a reasonable next leg higher? Absolutely not. Is that theoretically possible? It is. Is that likely? 100% no. I would say highly unlikely we rally and get above the 200-day. And if we do, I would say 5,800, 5,850, kind of that congestion range, that gap range we talked about before. That's kind of that's the area where you'd expect a snapback rally. So, I mean, a bounce this week getting up to that general range before another leg lower would make a ton of sense, I would say, from a technical perspective. But again, the market doesn't care what you think an ideal path would look like. It's going to do what it's going to do. But I would say, again, you know, if you get a bounce here, I'm sure many people will say, okay, that was the bottom. There's a big difference between a bottom and the bottom. And I would say there's a lot more the market would have to prove to me before I would say that is the place you want to really start accumulating for new all-time highs. A tradable bounce, 100% likely. Here's what I mean. This is the 2021 peak, right? This is December 21 into January 2022. Note how we had this great, beautiful, classic bearish momentum divergence, which may look familiar because we had a very similar bearish momentum divergence November into January of 2024 into 2025. So talk about the history not repeating itself, but rhyming. Here's that same 9.7% drop. And this is why I was talking to someone yesterday as the market was selling off. And they're like, well, it's about the same as that July pullbacks. That's probably it. And I'm like, well, sometimes not, right? This is the beginning of the 2022 bear market, which, if you remember, the low was in October of that year. So for the next 9 to 10 months, we were going down. But after the initial 10% drop, we had kind of a nice bounce higher before we ended up making a lower low. We then had a snapback rally where it almost looked like we were going to break back above 4,600. It was not followed through at all. And this was, again, just the beginning of a multi-month deterioration. So the point of showing you this is that a very buyable dip like this one in July and a very not buyable dip, or a dip that you probably don't want to be buying, but you want to be selling into strength afterwards, they look very similar at the beginning. And I think that's where you want to be careful. What happens is the move after, right? I mean, and then if you look at what happened here, we made, we recovered, and we recovered 100% of the way back to the previous high. We then made a higher low. We then broke to a new swing high. All of those things, I think, validated the fact that was a very buyable dip. And even if you waited for here, I don't mind waiting a little bit just to confirm that it's one of those kind of buyable rallies and not one of these, right? In this case, we made it nowhere near the previous high. We then made a new low. And so at that point, I mean, it certainly feels like a clear bearish phase that we've started. So I think the initial sell-off has now happened. This next bounce and what happens there, I think, is really important to follow, because both of those two examples that I showed you are very, very similar at this particular moment. If you draw an analog, the bounce after is where you started to differentiate the buyable dip from the not so buyable dip. Now, I zoomed in a little bit just to show you the candle. Earlier in the day, this was actually shaping up to be a big time hammer candle, and I had this saved just in case that would happen. It didn't play out. So my theme at this point, my thesis was always going to tell you this is absolutely probably a tradable rally to the 200-day moving average, if not a little bit further, given a bullish candle pattern. I'm not necessarily seeing that. I'm wondering if like the QQQs had a candle pattern. I mean, you may want to call this like a doji candle, but not really. I mean, I think that's probably cutting hairs a little bit, but I don't see it. I mean, this is kind of it's a doji-ish candle, but I mean, the open and close are far enough apart that I don't think I can call it that in all honesty and be intellectually honest about it. So I would say, at this point, I don't see a bullish candle pattern at all. I see just a market that continues to go down and has not gone up yet. Another thing to remember, and this was someone actually put it in the, I think on my YouTube channel, someone made a comment watching the replay last night, said, look at the weekly chart with the 50 and 200 week moving averages. And thanks so much, the person that did that. I took a look at what you mentioned. Really interesting, right? So this is, one of the comments is like, how do you think about the downside risk in this kind of environment, right? If this secular trend is still very good, right? If this is still a long-term secular trend, and we're just in maybe a cyclical pullback, right? One of those kind of garden variety 2022, 2018, 2015 kind of pullbacks that's not going to feel particularly good, but we recover from it. And it's just another pause in the big uptrend phase. Note how often since the 2009 financial crisis that the S&P has pulled back to its 200-week moving average in purple, and then the next leg higher has started, right? So I mean, when you're thinking of the general way to approach the market, when we break the 50-week, which is in red, we usually get down to the 200-week in purple, and the COVID low undercut it a bit, fair. But even if I bought it there and it was in the red a little bit, I'd probably still be happy afterwards a year later when we're much higher. So if we do sell off here, that looks like potentially the downside risk, where you could still call it a secular bull market. And I mean, if I'll tell you, if the S&P gets all the way down to 46.55, I'm probably super happy buying anything I can find at that level, because there's a chance we go down a lot further, but a very low chance. From a technical perspective, that's incredibly rare that we do that. That would be, I mean, then we're in a secular bear market, arguably at that point. To still be in a secular bull market, meaning a long-term uptrend phase, the pullbacks have been quite a bit, but that also shows you how much room we have on the downside where you could still label this a long-term bull market. And I think that's what you have to remember. When we see a pullback of 10%, it feels like the end of the world. It feels significant. Corrections can be much deeper and much more protracted. 2022, that was a 9 to 10 month correction, ended up pulling back from what, 4,800 down to 3,500 before eventually retracing 100% of that on the way up over the next 12 to 14 months. So the point of this is to show you that, long-term bull markets actually have plenty of room where corrective patterns can still fit within a long-term uptrend. And, again, I think if we get much further, that's where you have to start thinking about more aggressive downside targets. 5,500 still remains my downside target for this move. We'll see what happens when we arrive there. Also have to let you know, we have, as of today, had a confirmed bearish signal from the new Dow theory, or what I call the newer Dow theory. I feel like one by one over the last 4 weeks, I have a bull market top checklist. As I'm thinking about it, I think we've checked all 7 of those boxes. One we were waiting for was this one, which is the equal-weighted S&P and the equal-weighted NASDAQ 100. This is derived from Charles Dow's original work, where he looked at the Dow Industrials and the Dow Railroads, and basically measured. And if both of them are breaking out, that's bullish. If both of them are breaking down, that's bearish. If one of them breaks out and the other one does not, that is a early warning sign of a reversal. And we have had that early warning sign December into February, with the equal-weighted NASDAQ making a new high and the equal-weighted S&P not doing so. Now we have had both of these made a new swing low, and with that confirmed today, I think that confirms the fact that we're in a cyclical bear market. The way that this is fixed is they start going higher, right? Number one is these equal weighted indexes start reversing, and really at this point you need to see both of them make a new high to eliminate that bearish signal, or you get a bullish non-confirmation where one of them makes a new low and it's not confirmed by the other one. That's usually what would happen. What would happen first. So this, I think, along with my market trend model, my medium-term market trend model on Friday, turning bearish. This finally turning bearish today. I'm out of things that tell me that unless XYZ happens, we're probably okay. We've broken all of those levels, so I have to think that we're in a primary bear market until proven otherwise. Again, counter trend rallies are going to happen, but I'm thinking those are things you probably sell into and not got too excited about until proven otherwise. Looking at the breadth conditions, by the way, the small cap breadth, the AD line already made a new low. That actually happened about a week and a half ago. The New York Stock Exchange AD line almost made a new low today. Didn't quite do it, but it's really, really close. That's the main one that I look at. Cumulative advanced decline line is basically just looking at all the individual members of the exchange or of the indexes, how many up or down on a given day, and then stringing together those values. That breaks down. That would be another confirmational signal that the downtrend is happening. We're now at less than 50% of the S&P members above their 200-day moving average. That's down to around 42%. That's bearish when it breaks below 50%, which it finally did this week. The VIX is pushing higher. It has briefly traded above that 28, 29 level, but it kept pulling back below it yesterday and today as well. So we're very close to getting above 29 for me, based on the work of the Ned Davis research team years ago. Suggests to me high likelihood of much further deterioration. All right, let's look at some other charts. Again, this came out of the interview that I did earlier today for Forex Analytics, but we were talking about bond prices, and I was asked to, just sort of give a technical overview of the structure of the TLT. And it said a couple things. Number one, the breakout above this green trend line, I think, was really important, right? That was the high in September, the high in December. We tested that again in early February. We broke above there in mid to late February. That's a nice bullish reversal. Now we have made a lower high, or I guess a new high most recently, just below 93, and pulling back a little bit, chopping around the 200-day moving average. And I'm wondering if there's a little bit of a further deterioration with bonds. If we get that snapback rally in stocks and bonds have had an inverse relationship recently. So when stocks are rallying, bonds are actually pulling back. So if we do get a more of a counter trend bounce for the S&P, maybe testing that 200-day moving average, that most likely coincides with a further drop in bond prices. And maybe that gets back to make a right shoulder of an inverted head and shoulders pattern. Now, before you say, Dave said there's an inverted head and shoulders on the TLT, we need to buy it. Remember that, number one, not a recommendation, full disclaimer. Number two, remember that an inverted head and shoulders pattern like this isn't a completed inverted head and shoulders pattern until you break above the neckline. You have to get above that pink trend line, which is called the neckline, connecting the swing highs between the head and the two shoulders. That would actually complete that bullish rotation for bond prices. So I would not be surprised if bonds continue lower, especially if stocks get that snapback rally. Unfortunately, I think that could be setting up a much bigger rally in bonds that probably coincides with a much bigger drop in stocks. All right. Looking at year-to-date performance on some of these, I was just looking at this earlier today. I wanted to share it with you. As of today's close, the Magnificent 7 ETF MAGS is down 14.5% year-to-date. The NASDAQ 100, the Qs are down 7.8%. The S&P down 5.2%. The equal-weighted S&P down 1.9%. What's up year-to-date? Bonds. The TLT is up 4.2%. Gold continuing to be one of the brightest spots, I would say, outside of non-U.S. markets that are showing quite a bit of relative strength relative to the U.S. Gold remains a top idea, up 11.2%. I do own GLD out of that group of ETFs. All right, let's look at some individual stocks. I'll take a question or two. We'll call it a Tuesday evening here. NVIDIA, I just want to highlight one of the techniques you can use with these charts just to put them in context. I think a lot of people with charts like NVIDIA and these other technology names are just waiting for this full recovery. And you may be absolutely proven right, 100%, that we're at a major low at any given day. We don't know that for sure. But I would also tell you is with a chart like Nvidia, drawing some parallel trend lines just to show the pace of the downtrend can be really instructive because it helps you understand a little bit more about the structure. A lot of times these rallies feel super encouraging because it feels like a nice recovery. But when you start to look at the trend connecting the highs and connecting the lows, you make a channel like this, you realize that that rally literally just took us up to the upper end of this downtrend channel. And now we've sold off pretty quickly down to the lower end of this downtrend channel, which means do we get a counter trend bounce here? We absolutely could. And it actually would be pretty reasonable to expect that after we get to the lower end of that channel. Get bullish when we're no longer in the channel. That's the thing you've got to remember, right? Rallies within the channel are counter trend rallies until and unless we break out of that downtrend channel. That's where you can start getting excited about, okay, this is a new structure. This is something different. We're now breaking that trend that we've set. So I think Nvidia and other charts like this are in clear downtrend channels. So counter trend rallies from these points make sense. Does that change the fact that we're now in a primary downtrend? By my read, it does not yet. I mentioned some of the defensive areas of the market, like consumer staples, having some counter trend rallies mid-February into mid-March, coming back today, pulling back a little bit. So Brown-Forman is a name we've highlighted, getting back above the 50-day moving average, making some higher lows, down about 5% today as it pulls back from overbought conditions. Again, just like the counter trend rally in charts like Nvidia, why that makes sense here. It's the same reason why pullbacks after we're overbought after a protracted decline period make a lot of sense here too. And to the same degree as we talked about with Nvidia, there's a reason why I think the 200-day moving average is super valuable here. And it's noting, I think it's important to note that the stock has rallied up to a declining 200-day a number of times. Those have been great times to sell Brown-Forman, not to be accumulating more. What you look for is when this pattern changes, right? So look for a higher low, look for breaking out above the 200-day. That's when I think you can get really excited about the long-term strength in something like Brown-Forman. For now, I would say still a little bit to prove. Dick's Sporting Goods getting dinged today about 5.7%. This is the latest company talking about lowering expectations in their earnings report, and basically beat earnings, beat their quarterly estimate, but had to downgrade their expectations for the year. This is what concerns me right about now. And this is something that probably gets surfaced a little more a couple weeks out when we have really probably about a month out when we have first earnings of the year for Q1. It's like mid-April through early May. And basically what happened with Dick's Sporting Goods is, good quarter, but bad outlook. And that, unfortunately, the market doesn't, reward you for a good quarter. It dings you for having, downgrading long-term expectations, because that's what the equity markets are designed to do, is look forward down the road a bunch of quarters, not just looking at the most recent quarter to see what actually happens. It's all about estimates and expectations and how they might change. So Dick's Sporting Goods has gone from making a new high above $250 a share less than 2 months ago to now testing long-term support. We've got support around the 190 level. So maybe get a bit of a bounce here as we're oversold entering, nearing that support level. But overall, I think the failed breakout and now underwhelming forward-looking guidance here on their earnings report, unfortunately, is a story I'm afraid we're going to hear more of, as other companies like Dick's in their earnings reports and in communication have to address the pressures of consumers, the sentiment, the pressures of inflation and what that might mean, just the reality that economic growth is not as much of an ideal scenario that is likely as much as the market has been pricing in. MasterCard's another one. Again, some of these names that have been making new highs are pulling back quite a bit. MasterCard failed to hold its 50-day moving average, as most stocks have. As of today, we've reached the 38.2% retracement of the July low to the February high. Is this a reasonable point where you might expect a counter trend bounce? It is. The 200-day moving average is really important because that's where we bottomed over the last couple major corrections at or near that 200-day. But I also wanted to note the bearish momentum divergences. That again, if you end up writing a book on the first quarter of 2025 and this bear market top, it's on my list. But I've often had books on my mind that I've never gotten to. But bearish divergences, which proliferated in the fourth quarter of last year into the first quarter of this year, I think are a real part of the story. And look at how often MasterCard has had a big bearish divergence going into a major peak. Happened there in February and March of last year, really happened in October and November of last year. We did go briefly higher, but really this is more consolidating after that point. And then we have one again going into earlier this month. So bearish divergences are, I've learned not to ignore them because they often come before significant pullbacks that you don't really often want to be a part of. Expedia, I wanted to highlight. I think this is the last chart of the day, and then we'll take a question or two. Just want to highlight with Expedia the gap and fall. The gap and run is where we have a big gap higher on earnings, and then you drift much, much higher, which means good news, you had a good quarter. Even better news, investors are willing to pay even more than they have in a long time, if not ever before, to own more shares. And so the optimism is palpable. We have the opposite. We have the gap and fall pattern where we gap higher on earnings. And so far, that's basically been the top. Today, down another 7.3%. Gapping lower today, gapping below that February swing low, which is a problem. The 200-day moving average now in play. Airlines, travel, tourism. This trade is getting crushed. As I think the headlines from airlines have been probably the most compelling. Just talk about less demand for travel, particularly domestic travel in the U.S. It's weighing on a lot of charts like Expedia, like Delta, and others. And you're seeing that play out from a technical perspective. All right, that is it. Let's take a question or two, and we'll call it a day. 3P investor, lowercase r or capital R recession worrisome. I love how the capital letters could imply a degree of likelihood. I mean, listen, the markets. I mean, and this is what you have to remember. Like when I hear people, and I appreciate the question, people that have been saying that there's no way we have a recession or that it's just completely not going to happen. What we have to remember is that the market has been pricing in that fact through much of 2024, and certainly the latter half of 2024. The market was pricing in perfection. The market was pricing in a Goldilocks scenario that the Fed is able to, lower rates at just the right time and in just the right amounts, be aggressive when they need to be a little lighter. They're able to pause, which gives the markets time to sort of digest things. Inflation's coming down. It's just not a big deal. We have inflation data coming out tomorrow and Thursday. Watch what happens to this market. If either of those inflation readings are a little overheated, I think the market drops aggressively because the market has been pricing in lower inflation, economic growth, everything's good, no issues. I'm feeling a lot of issues right now, right? The headline risk is very real. The impact of tariffs is very real. The companies like Dick's Sporting Goods today acknowledging the headwinds that they're facing in 2025. Those are real concerns, and I think they're real issues that are now being reflected in the fact that the market's been had a 10% haircut in the last month. I had an interview earlier today, by the way, with Ryan Redfern, who's at Shadow Ridge Asset Management in the Austin, Texas area. He's the president of the National Association of Active Investment Managers. So I got to talk to him about some sentiment data, talk to him about general market perspectives, cycles, a number of different things. We'll get that interview out to you, obviously, as soon as we can here today or tomorrow. He was way more bullish or way more optimistic than I was at this particular moment. He was sort of looking for a viable low. I'm thinking this is more of a protracted decline, but that's okay. That's why we have a market. We have some different perspectives, but it was a really, really interesting discussion. I think you'll enjoy it quite a bit. But his comment was, when you have big drops like this, what we discuss is that remember that the market has recovered from 100% of corrections going back in history, right? We've always made a new all-time high. Sometimes it's taken a little longer than other times, but we've recovered 100% of the time. So when the market sells off of it in those major bear markets that I've experienced, they've always presented some fantastic buying opportunity. And whether you pinpoint the low, whether you're a little early or a little late, just getting in and having cash to redeploy when the market has dropped 10, 20, 30%, that's how really good returns can be made in your portfolio. So I don't know if I could say lowercase r or capital R. I'm not sure exactly what I'm voting on, but I think, yes, I think economic growth is a mirage at this point. And based on what I'm seeing, I think recessionary pressures are probably growing here. And I think the market's reflecting a much less optimism in that particular way. Well, that's all we have the time for. We're a little long today, but I want to appreciate so much all the questions that you have. A couple I don't have time for that I really like that I'm going to put in the mailbag. So thank you guys for watching live. Thank you for asking some thoughtful questions. We'll do an all mailbag episode on Friday of this week. But for now, I will say thanks so much for watching. Thanks for supporting me in Market Misbehavior. I wish you the best in your investing journey, and I'm so thankful I can be a part of it, hopefully helping you make sense of these markets. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a good night.